Today we're going to cover how property development finance works. Development finance is extremely hard to calculate, and whether you're a broker or a developer, understanding how it's calculated is very important. But before we talk about how development finance works, let's talk about what it is. So in essence, property development finance is a short-term loan, normally 12 to 36 months, used to finance the construction of, conversion or refurbishment of buildings. Essentially, the loan works backwards. From the total available loan, the lender firstly funds their own costs, that's their interest and arrangement fees, and next they deduct the cost of materials and labour needed to complete the project. And then any loan amount left over will go towards the cost of the land. Developments can either be residential, so anything from a single house or a block of flats to 300 properties on a new housing estate, or commercial, which includes properties like warehouses, office space, shopping centres and even football stadiums. Once the project is complete, the borrower repays the loan through the sale of the property or via refinance. The size of the loan is based on 4 key metrics: gross development value or GDV, an estimate of what the site will be worth when it's built, total project cost, the total cost of your materials, land and labour, minimum borrower equity or the minimum amount of deposit a lender will accept from shareholders, and day one land leverage. Development finance is the most complex property-based loan to calculate, so I'm going to break down how a loan is calculated into stages. The lender lends the lower of a percentage of the gross development value or a percentage of the total costs. The lender will have a cap for both of these things, and whichever one you hit first is the cap of the loan. The lender will also have a minimum deposit or amount of equity required from shareholders. This is normally expressed as a percentage of the total costs. There will also be a day one leverage cap, so even if there is spare capacity to lend more, the lender will have a percentage they will not lend above on day one relative to the property value. Hopefully you're still with me so far. You need to think of the loan being broken down into 3 component parts: the land loan and the build loan, and then the lender costs. Development loans, like bridging loans, are forward funded as standard, so the lender will retain their estimated interest costs from the gross loan. Once the lender covers their costs and their professional fees, the build loan and contingency will take priority next. Any residual or leftover loan is the land loan, and this is available to borrow against the land value, providing it respects the day one LTV, loan to value cap, and minimum client equity percentage. It's this combination of multiple variables that makes it very hard for borrowers to know what each lender will lend to them. One of my pet hates is where a lender will advertise they lend at 65 or 70% of gross development value, but then they will tweak all of the other parameters of the loan in such a way that they can never actually hit that leverage amount. So for a broker or borrower looking at 3 lenders that all advertise that they lend at 65% loan to GDV, you could be forgiven at thinking that they will all give you a similar loan size. However, the reality is that the difference between the loan sizes will run to hundreds of thousands of pounds in most cases. And that means hundreds of thousands of pounds of additional deposit that the developer has to find for their project. If you have full market knowledge or use search software like ours, then the pain of finding that additional deposit can be avoided. We explore this idea further in another video called The Cost of Getting Your Development Finance Wrong. Another key point to understand is that when you're looking to secure development finance, the cheapest debt isn't always the best. This is something that at Brickfow we call the development finance paradox, and you can watch another one of our videos to understand more about this concept, which is fundamental to ensuring that you're getting the most efficient funding. Sweat equity is also something a developer can use to their advantage. If a site has been purchased and enhanced in value through planning, this may be considered as part of the developer's equity. This is what we call sweat equity because all the hard work has added value. Every lender has a different way of calculating sweat equity. Some are a lot more generous than others, some will ignore completely. So make sure you shop the market or speak to your broker. Another trick to getting a larger loan is to make sure you've included site costs paid already. So if you own the site, things like debt servicing, security of the site, maintenance, these can legitimately be assigned to the project and the lender will take them into account for their calculations. So keeping a ledger is very important. To truly understand how property development finance works and to ensure you're securing the best value funding for your project, there are three key things you need to understand and consider. The first is the capital stack. The truth of it is that properly understanding how development finance is structured can mean the difference between success and failure as a property developer. I would say that if you really take the time to understand it, you will have a competitive advantage over 99% of your property developer or finance broker peers. Understanding how funding works is a seriously easy way to turbocharge your business. The capital stack is the structure of development finance or the different layers that fund the scheme. The typical stack has 3 layers and normally includes senior debt, mezzanine debt, and equity. Strategically determining the best capital stack for a scheme means minimizing equity investment and maximizing profits. To get your capital stack right, here's what you need to know. Debts are repaid from the bottom up, so the higher up the lender in the stack, the bigger the risk they incur and the more expensive their debt. Equity is always at the top of the stack, followed by mezzanine or second charge lending, with senior lending first charge at the bottom. Lenders will want visibility of the capital stack to see where they fit into the hierarchy of funding, and this lets them determine the potential return on investment versus their level of risk. Not all lenders require a big deposit, so shopping the market will help you to hang on to your equity for longer. Deposit requirements typically range from 10% to 35%. So for a development with costs of 10 million, a deposit could vary by as much as 2.5 million, creating a huge opportunity cost from lost equity if a deposit is 35% rather than 10%. Experiment with different loan structures to avoid hefty profit share payments. Like building a development, work from the bottom up when structuring your debt. There's a guide on brickfow.com that shows you exactly how you can do this. Interest rates. Like any financial product, development finance interest rates are dictated by risk or implied risk. Size matters. Risk and leverage are inextricably linked, so the higher the leverage, the more risk there is for the lender. One of the most common questions we get asked is what kind of interest rates developers can expect to pay. The simple answer is there is no simple answer. Every lender has a different way of calculating development loans, which is why it's so important to shop around for funding. If the same project is sent to 10 different lenders, you'll end up with 10 different loan amounts and 10 different lots of interest rates and fees. For loans over 1 million, you can see some of the typical rates on the screen. When borrowing less than 1 million, borrowing costs will increase due to the resource required and relative costs of underwriting a development finance loan. The labour cost to a lender of sourcing and underwriting a £10 million development loan is much the same as a £2 million loan, but with 5 times the return. So they all prefer to focus on larger loans. For loans of under £1 million, the market is still covered by mainstream banks and challenger banks, but the biggest presence is probably with specialist development funds and bridging term development lenders. Pricing might typically be 1.5% to 2.5% higher. Any loan below 1 million that carries an interest rate of less than 10% is competitive. In addition to interest rates, the total cost will normally include an arrangement fee, perhaps 1.25% to 2%, and an exit fee of 1 to 1.5% of the gross loan. It's therefore very difficult to compare lenders on a like-for-like basis because of the 3 different costs involved. Most lenders have a minimum annualised rate of return on their capital, and it's this combination of the 3 costs that are used to meet this. If a lender is charging a lower interest rate than their peers at the same leverage level, expect to pay higher arrangement fees and exit fees, also known as in and out fees. At Brickfow, we've invented the term true monthly cost as the best way to compare fairly. This is the interest rate plus the arrangement fee and the exit fee divided by the term length to give an all-in monthly cost. So true monthly cost would be interest rate divided by 12 plus the arrangement fee and exit fee divided by the number of months in the term. So 9% divided by 12 plus 3.5% of fees divided by 18 is 0.94% per month. And that is on the results screen for every Brickfow search. Personal guarantees. A personal guarantee is the borrower's legal promise to repay loans issued to a business where they are a beneficial owner. So providing a personal guarantee means if the business becomes unable to repay a debt, then the developer accepts personal liability, meaning they can't just walk away. They are standard practice for development finance and are expected from all shareholders above 25%. Or you could offer something else such as a corporate guarantee. The industry average is 15 to 25% of the total loan amount. In practice, personal guarantees are conceptual security rather than actual alternative security. They're there to ensure both lender and borrower are strategically aligned. Before the financial crash in 07-08, most lenders didn't ask for them, and then when values plummeted after Lehman, developers could throw the keys back at the lender and walk away. Personal guarantees stopped that happening. Lenders are lenders, they're not developers. They want you to build the thing and then get their money back at the end. Lenders don't expect to enforce personal guarantees, and they only do as a last resort, but lenders will tell you that the primary reason they exist is to stop borrowers walking away. So my key takeaways for understanding how development finance works. Shop around for your development finance. The cheapest loan probably isn't the one when you factor in the cost of the increased equity that you need to put in. Properly understand the capital stack. Most people know the term, but very few really understand it. This is a difficult market to navigate, so use an experienced broker to help you. Don't forget, at Brickfow, we do the shopping around for you, so saving you time and money. If you're a development finance broker, you can compare loans from over 40 lenders in minutes and apply online on behalf of your clients. If you're a developer, don't forget to run your numbers through Brickfow to check if a project is financially viable, and then when you're ready to apply, tell your broker about Brickfow or get in touch and we'll refer you to one of our preferred brokers. All details are on the screen, and I'll drop some links to the guides and other videos that I mentioned in the comments below.